My guest today is Mac Lackey. Mac has founded and sold 6 companies, all with 7 and 8-figure exits. He's also the majority owner of a football club in Spain, which is called Algeciras. Sorry for the pronunciation, but this is the first time I have a guest who owns a football club. So thanks a lot for coming to the Holdco Builders podcast, Mac.
Thank you for having me. Excited to be here.
You've built and sold 6 companies across very different industries. We will cover all this and we will cover the owning the football club story as well. But let's first start maybe your life before the first company. What were you doing? And then you can slowly and steadily get into like the story of first business.
My early life as a child growing up in the US, my passion was football, or what we of course called soccer. And so most of my time as a child and as a teenager and even into sort of a young adult, that was really what I was interested in and focused on. So all of my goals and dreams were really related to football. And so before even going to university, I went on a scholarship to play football. And that was really, in my mind, why I went to university, not for the education, but to play football. So that was really the first part of my life and really defined a lot of my passion.
You started your first internet company back in 1995. Was there any other business projects before that, or what's the story there?
No, that was really my first company. So I played football through university. I played professionally very briefly in the US. When I came out of university, this was before we had what's now called Major League Soccer. There was not a very good professional league. It was not very realistic for Americans to go abroad to play. So I played professionally, but I very quickly realized there was no path for me there. I met one of my teammates who was a few years older, was working in a technology startup. And I ended up getting a job working in the marketing department of this company. And I literally knew on the first day of that job, it was really my first real job outside of football, that I was going to do my own thing. And so I lasted for, I think it was about 6 months working for this company before I convinced an engineer to leave with me to start my first business back in 1995.
What was the business? Did you end up selling this one right away, or what's what?
Yeah, it was a company called InTouch Interactive. And if I know you're younger, 1995, everything looks different when you look back. But in 1995, the internet was really just starting for most people, right? So Netscape launched the commercial web browser, and that was really the beginning of the internet. And my business partners and I believed that the internet was going to change everything in business and life. However, at that time, a lot of very smart people, including my mentor and people that I respected in my hometown, they were all saying the internet was a fad, that nobody was ever going to put a credit card on the internet. People couldn't trust the internet. And so we were really doing something that felt very risky and kind of against the advice of a lot of smart people. So we started, and I look at it myself as, fortunately, we started an early internet company because we caught that internet wave before most people saw it. And we owned the company for about 3 years before we sold it in 1998. And by that point, the internet, of course, was becoming very hot and growing really quickly. And so we sold that business. And it was really my first kind of life-changing exit. I mean, I went from I was a middle-class kid. I was newly married. My wife and I were married in 1996, but we were struggling. I mean, that business, even though I was very excited about the internet, I wasn't making any money. I mean, and we were living in a 1-bedroom apartment, and it was very difficult. My wife had multiple jobs. And so all of a sudden, I went from eating the cheapest food we could buy in a 1-bedroom apartment to an 8-figure exit in my mid-20s. And, life changed in a lot of ways for me.
And then what? It's year 1998. Did you take some time off? Thought of a super early retirement, or what was next?
No, I did what I think a lot of, doesn't even matter age, I guess, first exit founders. I had most of my bucket list items and things were material. I had a car I wanted, I had a beach house I wanted. And so I literally checked off a lifetime of financial goals very quickly. I went out and bought the, red 911 convertible I always dreamed of. And so I did that. The company that bought us did a lot of acquisitions and went public in 1999. So I stayed with the company until the day it went public. And then I resigned to start my next business, which was really the intersection of my passion for this emerging internet and technology with my passion for football. So I created a kind of a football media company that was internet based. As my next project. I didn't take one day off. I went from first company to second company, mostly because I was really excited and passionate to build something in that space.
When it comes to this first exit, did it, or maybe how did it change you as a person, like having this early success? I mean, growing a business for 3 years and then exiting for 8 figures. I don't know too many people who have been able to do that and who are able to do that. So what do you think, looking back, how did it change you as a person, as a man, and what did it do with your beliefs when it comes to success and maybe failure and how hard it can be?
Yeah, it's a good question. I mean, because I was so young and it was so, in some ways, I mean, if you asked me during 1995 and 96 and 97, I was working incredibly hard and in a lot of ways struggling. Like I said, I mean, even paying our bills was difficult. So until the exit, I would not have said being an entrepreneur was easy at all. That was very challenging and difficult. But the exit, what it did, it gave us my wife and I gave us, of course, some financial resources that I honestly probably never even dreamed we would have. But it also validated kind of a formula in my mind that, it's worth taking risk, surrounding yourself with really smart people. One of the decisions we made that worked so well is when we were building that company, every time we would make any money, we used it to hire better people, engineers, designers, and my partner and I would often sit at a coffee shop and kind of look at each other and say, can you make it another 30 days without getting paid because we want to hire this engineer? And we really made the decision to use every resource we had to get better people. And so that formula was kind of validated in my mind, take risk, go after big opportunities, and surround yourself with amazing people. And I think the exit validated that that's a formula that I thought would work going forward.
Next business, football media business. What was the year you started it, and what's the story there? We will go step by step just to understand the timeline and what we've been able to do, because this is a wild journey, I can see.
Yeah, it was a wild journey. So that business we started in 1999, and in a lot of ways it was the height of the internet, what people now call the bubble. So everybody was talking about the internet. There was a lot of interest. So it was very different than starting my first company because everyone was excited about what we were building. I had the validation of that first exit. So people thought I was, going to be a successful entrepreneur, and people were excited about what my partners and I were building. And so in 1999, we became, I think, the largest producer of non-televised soccer or football content in the world. And so we were, we had a whole team of editors and writers. We were covering soccer and football leagues all over the world, Europe, Asia, the US, and it was moving really fast. What's interesting about that company is we ended up selling it in 2000 very quickly. So I went from starting the company to selling the company in I think it was 14 months. And however, we sold the business in July, but as you and your listeners probably know, the dot-com bubble burst in March of 2000. So March of 2000 was horrible for internet companies. Valuations kind of disappeared. Nobody wanted to invest. Everyone thought it was over. A lot of people would say, okay, we told you that was a fad. Now it's gone. So we, in March of 2000, had a big venture capital firm in New York that wanted to give us a lot of money to continue to grow and build this global media company. And then all of a sudden we went from that really hot internet startup to I had 2 weeks of payroll left in the bank and we were about to go under. In a lot of ways, the fact that we were able to navigate that company to an exit, we sold to a public media company in Europe. It was another 8-figure exit. I was incredibly, lucky and grateful that we were able to even save the company, much less create an 8-figure exit. So it was a really interesting time. It's probably my favorite. When I look back on that company and the strategies we use and decisions we made, it's probably one of my favorite stories, but it was very stressful at the time because we honestly didn't know if we would make it. I think most anyone around us, smart business people, would have looked at our company and said, you won't make it 30 days. And so the fact that we sold it for, $15 million was, a miracle in a lot of ways. So it made it a great story.
What are maybe some of the lessons or some takeaways which comes to mind? Because 2 back-to-back exits in a reasonably short period of time in a very uncertain economy, especially when it comes to the second business. What comes to mind when you're thinking back and people reaching out to you these days asking how were you able to do that when it comes to building those businesses so you're able to sell it for 8 figures? I
learned something really important, particularly in that second company, that second exit. And it shaped not only, that outcome, but really everything I've done since then. And one of my core beliefs, and that is, if that business was looked at or sold based on its financial performance, our revenue, our profits, anything reasonably kind of financial, it would have been almost worthless, because we weren't generating much revenue. We weren't profitable at all. We hadn't generated any profits yet. But what we did is we found a buyer, and really more than one, but we found ultimately a buyer who really needed what we had created. They thought that our media, our assets, our intellectual property, and to some degree our team was so valuable, it was worth $15 million for them to have it. And so the real lesson in that for me was, rather than focusing on trying to always drive revenue or get profitable or even generate profits, I had this sort of epiphany of, what really creates value is when you're building something that you believe in and you think it's the right opportunity. The real key is who in the world needs it or wants it. And the more you can think about who needs this intellectual property, who needs these assets, who would really value the team I've put together here, it is, it's a great way to create an outcome because those are the people that you need to be reaching out to when it's time to sell the business. But it also really becomes a powerful lens to look at your own business. And so I always call it kind of the exit lens, or using a third party, what would a prospective buyer see if they looked at my business? So it helps founders. It helped me look at my businesses differently because I was constantly thinking not only from my own view, but what would this prospective buyer think about my decisions and think about my new products and think about my services. And if those things were becoming more valuable to them, I'm probably making good decisions. If they wouldn't value them, maybe it's not the best decision. So that became kind of a theme for me, really, and has been the rest of my working life, is really thinking from the earliest stages, what would prospective buyers see in my business and who really needs or wants what I've created?
Hey, a quick pause from the episode. I want to talk about today's sponsor, CapitalBad. If you're hunting for small business deals or want to put capital to work alongside great operators, look no further. CapitalBad. It's a marketplace for acquisition entrepreneurs where operators post real, active deals and investors review, diligence, and fund them. And the best part, CapitalBad standardizes the stuff that usually gets messy. Take terms, governance, distributions, so everyone starts from the same clean template. It basically brings private market discipline to small business investing. The returns can be very attractive, and the workflow is smooth end-to-end because it's founded by Travis and Tonza, who are serial entrepreneurs. They've sold businesses. Tonza himself runs probably a fund very soon. So far, he has done 2 acquisitions, and he used to be a guest on this podcast as well. But again, when it comes to CapitalBad, and when it comes to you raising capital to buy a business or you want to curated exposure to acquisition deals, head to capitalbad.com. And make sure you tell them that the Holdco Builders sent you. That's capitalbad.com. And now let's go back and listen to the episode. Did you get this light bulb lesson with the second one you built, or you already had this after the first one, or when it really happened? Because it's about the lesson.
Yeah, it was really from the second one. You know, the first one, so, you know, as you said, and I guess we'll talk about them. I mean, I've had 6 exits. And so the only one of my exits that felt fundamentally different was the first one. And it was different for 2 reasons. One, people were coming to us and wanted to buy our business. And my partners and I were kind of like, what is going on? That, like, they were reaching out to us. And that really never happened again, or at least I changed the formula. I'm a big believer in you sell your company. You're proactive about it. You find buyers. You learn how to articulate what you've created. But it was very different in that first one. And I think I knew so little about the exit process when the first one, we were just kind of going through the motions. We didn't know what we needed to do. We didn't know how to set things up. We didn't know how to protect ourselves. We didn't know how to, you know, ensure that we were getting as much of the money as we could by being smart about things like taxes and legal structure, all that stuff I really didn't understand. So I learned a lot of these lessons with my second exit, and then I applied them to most everything I did moving forward.
Now, you said with the second company, the numbers didn't really make sense when it comes to, like, they weren't that great. So
yes,
so someone could pay, like you said, like 15 million for this business, but like, how many strategic buyers did you talk to? What was the approach to them, and how was really I guess you had to, like, open their eyes or educate them, like, how much value this acquisition would bring to them, and how much value it could bring to them. So maybe what has been your thought process behind this? Like, how do you find the right buyer and really motivate them, or maybe open their eyes or make them dream of this business you've built?
Yeah, it's such a good question. And, you know, to be clear, you know, I think it has evolved a lot. You know, I've gotten, you know, not only I think good at it myself, but now I, you know, mentor and coach other entrepreneurs how to do it. So I, you know, when I sold my second business, it was a new thought. It was a new strategy. It was, you know, so it's evolved and gotten a lot better. But in that particular case, we looked at a couple things. We said, you know, we brainstormed and said, all right, what do we have that's valuable? Number one, we were producing so much content, and we were covering probably more leagues with more detail and more statistics than anyone we knew of, including very large media companies themselves. We were probably, because all we did is focus on football. We didn't talk about cricket or rugby or American football. It was, you know, international football, every league at very detailed levels. And so we looked around the world and said, there are media companies that are really good, but they're not as deep in football as we are. Maybe they would want our football content. We also looked at, particularly in Europe, and said, there are a lot of European media companies that don't have a presence in the United States. And the United States is the biggest consumer market in the world. And so we're generating a lot of interest in the US from customers, even though we're talking about English Premier League or La Liga or Serie A, the customers are in the United States. And so we said maybe European companies would want that. So it's kind of a process that, again, I teach people now, but it's basically trying to think about what you have that's valuable and who in the world would be interested in that. So ultimately, with that second company, we decided that the European companies were probably the best buyers. I literally boarded a flight to fly to London, where some of our biggest competitors were located. It became a really funny story, which I'm happy to go into detail if you want. But the short version is I literally got on a plane with no meetings and landed in London and was cold calling our competitors. And I was basically playing them off one another. I was telling one that I was meeting with the other, and so they wanted to meet with me. And then I called the other one and said, I'm meeting with your competitor and we're going to sell the company. And so I ended up getting meetings with both of them and got a letter of intent pretty much in the first meeting because they were afraid of us selling to their competitors. So they wanted to not only did they value what we had, they definitely didn't want their competitor to get it, which is something else I learned, is the value of that kind of, competitive landscape or bidding war for your company.
And when it comes to your sales skills, I guess you have to be world class at this, obviously, when it comes to creating this urge for those competitors competing against each other and making your company so attractive. Maybe what is something you're happy to share, what works so well? Why I'm asking those media related questions is I built this Holdco Builders podcast, this private equity guy, Twitter. On the revenue side, it's probably not the most valuable business, but for the right firm, for the right community, it could be worth, I don't know, you can tell a lot of money for someone because it has access to lots of people interested in buying businesses who have already bought the businesses, different GPs of funds, LPs of funds, a lot of different investors and business buyers, very valuable audience. So I'm asking because just another day I just posted on Twitter that I'm looking for a partner who would like to build this media brand, media asset. So this is why me being a bit selfish asking those questions from you.
No, but I think it's really it's a fundamental question and it's an important one. One of the things that I look back over my life and career, and I feel very fortunate that I've had some success. I don't feel like I was great at a lot of things. There are a few things that I was particularly good at, and one of them was really this kind of creative thinking around who values what we have. And what really made that easier for me is trying to constantly put myself in a buyer's shoes and looking at my business through their eyes. And, I think I often call it using buyer's math. And so for someone like you, if you look at your podcast or the media company you're building, it could be, your guest, it could be your distribution, the people that listen to your podcast or that are following you on Twitter, and you aggregate that user base and you say, okay, well, that user base is not generating a lot of money for me. But if this other company had my user base and could sell them one thing and maybe 10% of my customers bought it, what would that number be? And that simple equation oftentimes will take a business that is not doing a lot of revenue or generating many profits and say, but in the right buyer's hands, it's worth millions of dollars. I was coaching one of my clients, a member, literally this past week, and they have a very early stage technology. So it's generating revenue. It's a great concept. They have a patent pending, so there's intellectual property, but they're just not having a lot of financial success yet. And so we started talking about particular buyers, and one buyer, which was a large media company, came up and I said, well, how many customers do they have? And the answer was 1 million. They have 1 million customers. I was like, okay, well, so if 10% of their customers bought your product, it's probably worth $25 million. So it doesn't matter if you're generating revenue or profitable now in that buyer's hands. If they believe that 10% of their customers would buy your product, it's worth $25 million right now, and it'll only grow in the future. So that's kind of like switching the mind around to say, it's not about what I have, it's about what I have worth to a buyer. And so using buyer's math to me is just really a powerful way to shift the dynamic in terms of negotiating, finding partners, finding investors, etc.
Did you have to educate your buyers of what this tool which you had, this football media business, access to all information, all that? Did you have to educate them that this is something they need, or when they saw the numbers, the users, daily users, they already know that, okay, this is what we need?
Yeah, so in that case, it was a combination of two things. One, I always feel like it is on the entrepreneur to educate buyers to some degree. Like, you know your business better than anyone, you know the potential better than anyone, and so you are probably the best at educating them on where the real value is. But the other thing, which is another theme that I would mention that we found in this first company, is when we were building it, one of the things we did is we were actually, acquiring, even though we weren't using money, we were going around and finding existing internet companies, radio businesses, media businesses, and we were rolling them into our media company. We would say, Mick, you've built something great. We will give you equity in our media company if you'll take your podcast and put it inside our business. And by doing that, we basically created all this exclusive and proprietary content that the only place you could get it on earth was through our platform. And there were a few things that we had, particularly statistics, that we were the best source for the statistics. And what was shocking to me, but it makes sense in hindsight, is one of the buyers, because they were based in the UK, again, big public media company, a lot of their customers were using data for betting. And that was not something that we even thought about in the US, but people wanted our data because it talked about players, how many goals they had last season, and trends. And that data was so valuable to this company. And so to me, that became another kind of theme of mine in my, working life since that moment, which is I always tried to think about, if I'm creating something that's valuable, can I make it proprietary and exclusive? Can I, put a trademark or a patent around it? Can I make sure that I'm the only place that you can get this content or this software? And so that exclusivity was something that, I also have focused on a lot in my career.
Hey, one more quick break for operators and acquirers. And today's sponsor number 2, Spacebar Studios. What they do is they turn neglected firm newsletters into deal and relationship engines. Why it matters? It's because consistent on-brand emails surface add-ons, warm broker and banker relationships, update LPs, attract founders, and support portfolio hiring without you putting too much time and effort into this, because they do it all for you. Again, hands off or hands on, this is your call. Go set up a call with them, talk to them. They're professional marketers. They're very good at what they do. Many Holdco Builders listeners have been signing up with them. They run this free trial for 2 weeks where they set everything up. So there is simply nothing to lose. Go to spacebarstudios.co and book a free call with them. And I'll put the link in the description as well. And now, back to the episode. Okay, we are now on year 2000 July. You exited the company after 14 months building it, founding it, building it. You're now smart. You know your thesis works, that your financial numbers don't need to be there, but if you have this, not sure if it's a moat, but something like super attractive for a buyer, you can sell it for very attractive numbers. So what's next?
So my next kind of opportunity was during building that second company, because I had some success, other things were coming to me. People were reaching out about me investing in their startup or helping them start something. And so I actually co-founded a business, around the same time I was building that second company, I was the chairman. I was kind of the, strategic thinker, but I wasn't the CEO. I was not in the day-to-day business. It was a company called Etain, and we were basically building something very similar to my first company, internet-oriented software. And that company, the board of directors, after I sold my second company, said, you know what? We've already spent the money that we raised to start it. Mac, you're the largest shareholder, even though you haven't been active in the company. Would you come over and run the business? Would you be the CEO? And at first I thought, it's a business that's struggling, and it's at a time where the internet and technology was not, it was struggling. The internet, I forget what they call that period of time, but it was like the wasteland. Like nobody was building internet companies. A lot of them went under. And so I thought, this doesn't feel like the right career move, but I also didn't want it to be kind of a scar on my resume. I didn't want it to be a failure. I was the chairman of this company. And so I basically agreed to come over as an interim CEO to this company during this kind of dead period. And very quickly, we decided that the way to build the company was to merge it with some other, what I would call similarly struggling technology companies, people that were building interesting things, had smart people, but they weren't really doing well because the internet was kind of in a lull. Technology was in a lull. And so, we put a couple companies together and got that business growing during this downturn. And that business for me was interesting also because I wanted to be very aggressive. I was the largest shareholder, but I think it was 4 other business partners who owned, part of the company. We had some investors, and my view was this is the time to be really aggressive when everyone else is in despair and struggling. Like we could really grow something big. We could take a lot of risk. But my business partners were basically saying, Mac, why would we take risk? Like the business is doing well now. We're not even having to work that hard. We're shooting basketball at lunch and making pretty good money. And to me, I thought that's not what I want at all. I want to take risk. I want to build something really big. So ultimately, I decided to sell my ownership to my partners and to a larger private equity firm, and basically stepped away from that business. So I sold, but I sold to my partners because I wanted to build and do other things and be aggressive, and that just wasn't where their mindset was. And what's interesting about that is that business sold for 9 figures, but it took them another decade to get to that point. And amazing what they built. However, I think over those 10 years, I built other companies. I had kids by that point. I, spent every day, with my kids. I traveled the world. It was, and so to me, it was another lesson that, what I valued the most in those moments, and basically every moment since, was time. The most valuable thing for me was, do I have freedom to do what I want with who I want, build what I want, and still be home for dinner with my kids every night? And so we didn't talk about that much, but that was the timing of selling my second company. July of 2000, my first daughter was born 30 days later, and it changed my whole worldview. Everything from that moment on just was based on, I need to focus on freedom of time. Not that I didn't care about money. I was still passionate about building companies, but I just never wanted someone else to control my time.
What is your take when I say opportunity cost? And what I mean in here is by that time you already had back-to-back success. People really wanted to work with you. You investing in their businesses, you working together, you maybe training their teams, becoming a CEO in their struggling companies. How did you make decisions of what exactly to do opportunity-wise, and maybe if we bring there like this extra sauce, which is like the focus, like just focusing on this one thing to grow this instead of just maybe having like so many different things going on at the same time? What was your take?
Yeah, so I think like a lot of entrepreneurs, I made mistakes. You know, one of the things I discovered in the early 2000s, you know, after my second exit in particular, is I was, to your point, a lot of people were coming to me. I was doing, you know, my first angel investments. I was investing in other people's technology companies and startups. I was on the board of some companies. I was starting and helping people start multiple things. And one of the things I realized very quickly was I don't think I'm a good investor. I realized that what it takes to be a venture capitalist or private equity or a really good angel investor is a set of skills, due diligence skills and financial skills and things that I don't have and I'm not interested in building. You know, so some of my early angel investments where I took proceeds from my early companies and gave an entrepreneur $25,000 or $50,000 and said, here, go build something great. A lot of those didn't do well. They very quickly went out of business or they lost my money. And so what I realized is that when I am building something and I'm betting on myself and I'm betting on the team that I've picked and an idea that I want to pursue, those are things that I can take a lot of risk and I can put a lot of focus in and I feel very confident in. Not that they're always going to work, but I was confident. But if someone came to me with an opportunity, but I was going to be a passive investor and they were running the company or they were trying to find the buyers or the investors, I was not good at that. I was not good at figuring out how to invest and where. So I made a pretty early decision that that was not going to be my personal focus. I was going to be a large investor in my own companies and I was going to take a lot of risk with my own balance sheet, but I was not going to be a prolific investor because that didn't feel like my skill set. And I learned that the hard way by losing a lot of money.
What about like, I think we are now on the third company you just exited, selling to this PE firm and your partners. What has been the feedback from your wife and family of you being so, obviously building a business, it brings some stress and long hours. Like how have been the conversations with your better half, with your wife? Like, should you go and start another business? Should you maybe take some time off? Like, how has it been all the time, like at this period as well?
Yeah. So in the early phases, I mean, one thing I feel very fortunate, you know, my wife and I have been married, you know, decades now. And I look back and when she and I were dating and when we were married, not only had I not sold my first business, I don't think most people would have necessarily even said Mac is going to be successful. I mean, you know, I'd been kicked out of my first university. My grades were okay. I was focused on playing football. I mean, I didn't look like here's a kid that's going to go be very successful in life. And so I was in a lot of ways, I was very thankful that my wife and I were married before I had success because I knew she was committed to me regardless of our financial situation. But to your point, you know, after we had some success, when I would tell her, you know, like even with my first business, the buyer wanted me to stay around. They were paying me very well. They gave me millions of dollars of stock options if I stayed, and I walked away from all of it to start my next business. And not only did I walk away from it, I risked a lot of what we had to, you know, become an investor and not make any money. I wasn't taking a salary. And so she was supportive for sure, but worried, like, why are we taking so much risk? You know, you finally got a salary. You finally are getting paid every month. And to some degree, I think that continued a lot of my career because, you know, when we were early married, it was just she and I. And then in 2000, we had a little girl. And then in 2003, we had another little girl. And it was like, you know, Mac, now we have a family. And now that these girls, we'd like to put them in a private school because my wife and I were public school kids, and we didn't have the luxury of a, great education, and we wanted something different for our girls, and we wanted to be able to travel with them. And so in order to do those things required, maybe, financial resources and stability. And I constantly would say, I'm going to go start something new, and my salary is going to go back to zero. And so I think my wife was supportive, but always probably worried and thought I was crazy at the same time. But
okay, let's continue. We are in early 2000s. What about company number 4? What's next?
One of the, if you look back over my first 3 businesses, the common thread between those were, technology companies to some degree, internet oriented. And I was probably, because of the experience with that third company and my partners, again, we were friends. It wasn't a big fight. It was just, we were not seeing the world the same way. I kind of wanted to step away from technology. I wasn't sure what I wanted to do. And I was having breakfast with someone who they were actually interested in becoming a technology investor, and they wanted to talk to me about it. And so we were having breakfast, and they were surprised to hear that I was really not personally interested in technology anymore. I wanted to do something different. And I said, I don't know what I want to do. And they asked me, would you ever do anything in apparel? And I said, well, I love clothes, but I don't know anything about apparel businesses. I have no idea. And so as we were finishing breakfast, they said, they were aware of a young founder who had an apparel idea for a company that they wanted to create, and they were struggling. They couldn't find money. They couldn't get it off the ground. It was literally, there was no product. It was just an idea. And so we walked out to his car, and he said, let me hand you the business plan for this company. And if you like it, follow up with this kid. So long story short, I went home and I read this business plan for a company called Mountain Khakis, which was an apparel company based on the outdoor industry. And I kind of fell in love with the idea. I just said, wow, it's a very different industry. I liked the idea, but there was literally no product. I mean, it was a sketch of a product. It was an idea and a concept. There was a name, and that was about it. And I thought, wow, this is such a cool idea. And so I spoke to the young entrepreneur that had the idea, and I basically told him, I'm going to help you create this company and take it to market. And so that was the beginning of what, a company called Mountain Khakis. The story, like a lot of these, evolved a lot. As a matter of fact, that original, the idea guy, Jason, we bought him out very early. He didn't really continue with the business. We gave him some money, and he kind of moved on to other things. Myself and one of my longtime business partners kind of came in to build this company. And it was so fun learning a new industry, new products, and so that business was probably one of the more fun periods of my entrepreneurial journey, just because, and one of the reasons I loved it, this may resonate with you or some of your listeners. In every industry and in every business, there are these preconceived notions and ideas based on how people do things. Like, it's just how things are done. And we kept running into that with early Mountain Khakis. We would go in and talk to retailers that we wanted to sell our product to, and they would say, we only buy in spring and fall. We buy twice a year. And we would always say, why is that? Well, that's just the way we do it. And we were like, we're not going to do it that way. We're going to change that. And so there was a lot of this, we're going to do things differently and prove that there are different and maybe better ways to do things, even if you've done it a certain way for decades. And so we innovated a lot of things with Mountain Khakis that really changed the way the industry, in the outdoor industry, kind of did business, particularly because we started with pants. And as boring as that sounds, our competitors, the North Face, Patagonia, these were really big brands. And we'd go to retailers and they would say, look, we like your product, we like your brand, but we only sell 5 or 10 pair of pants a month. And our opening order was this big display that had like 80 pairs of pants on it. And they would say, we won't sell that in years. And we would go to them and say, we'll give it to you for free on consignment. Just put it in your store and we'll see what happens. And it really changed the way retailers sold pants, the way they were displayed, the way they were handled. And very quickly, we were outselling the North Face and Patagonia. And so it really changed the way people thought about some of the retail strategies that, of course, a lot of people copied and you see today. But that was a really fun chapter because it was such a departure from technology. However, because we had this technology background, we also were very early for apparel brands on the internet. We had an internet store from day one. We started selling online. We sold to Amazon very early. And so we were early with a lot of technology, despite that not being our focus.
You mentioned this period was the most fun. So few follow-up questions. Which period has been the happiest? Which has been the saddest? And in which period have you been like most worried, if you can remember?
Yeah, it's a good question. I mean, one thing that I've tried to do over literally 30 years as an entrepreneur is work on things that I was personally passionate about. And so most of my companies, with a few exceptions, were things that I was personally excited about. You know, I've had this common thread of football. You know, I keep going back to football. With a lot of my companies, football was either a customer base or a focus of our business. Things like that outdoor company, I was excited about learning something new, a new industry, a new product. And so that really helped me get out of bed in the morning excited. That was a big motivation. Is like, I love the subject. I love what we're building. I believe in it. And so that theme was common. I think when we talk about that third business, that was a good example of a period where I wasn't happy. I didn't love it because I really didn't love the subject matter of the business. I didn't love the business itself. It was just the opportunity to make money or the opportunity to build something, but I didn't really have a passion for it. And I discovered, of course, it makes sense, that isn't very sustainable. So I look back over my life and think, companies like that was a bad choice. I mean, it worked out fine for me. I made money on it, but it wasn't a good use of my time because I didn't love it. And if I didn't love it, I probably wasn't going to build it into something amazing, or something I wanted to do every day. And so some of my later companies were literally built from day one that I knew I would want the opportunity to sell it, but it was a subject that I was so passionate about that I also would have been very happy to build it the rest of my life. It's like something I wanted to do, I believed in. And so I think if I think about, to answer your question, when I've been most happy is when I am building something in a subject I'm excited about, where I think it's a challenge and I want to build something great. When I've been unhappy is when I find myself pursuing something for a purely business or financial reason. Oh, it's going to make a lot of money. Oh, it's going to grow really quickly. It sounds good. And then I get into it and realize that's not really getting me out of bed in the morning. As a matter of fact, I'm not very happy and I'm probably trying to get out of it as quick as I can.
So when it comes to exit DNA, how excited are you today building this? Because you have all the knowledge, all the experience, probably the money and the opportunity to do almost like whatever you want, build whatever you want, and you can even retire and just do nothing. But still, you decided to build like exit DNA. Let's talk about this. But where are you when it comes to this excitement level today?
Yeah, it's a really fair question. So I am coaching and advising entrepreneurs, from all over the world, and we do that. One of the things we do is called Exit DNA, and the whole idea is helping entrepreneurs design their businesses so they have the option to sell, that if they decide to sell, they'll know that it's at maximum value and it's really on their terms. And that is something I love because two reasons. One is I get to sort of live vicariously through entrepreneurs, so helping others achieve their goals and dreams. I'm so fortunate to have had 6 exits. Most entrepreneurs, if they're lucky, will have 1 exit in their life. And honestly, if you interview entrepreneurs that have sold their companies, I think it's over 90% will tell you there are things that they could have or should have done that would have really changed the exit and made it better, made them more money, made them happier. And so because I know how much is at stake, and I know that most entrepreneurs don't know how to exit, I really enjoy helping in that process. I get to see people, because of things I'm sharing with them, literally have life-changing outcomes. So I love the fact that I'm living vicariously through them, but I also have to admit it's also nice because I have zero risk. It's not my business. I'm helping them. I have no incentive to do anything other than advise them or mentor them, help them get a great outcome. But when I go to bed at night, I'm not worried about making payroll or what macroeconomics or tariffs or whatever's going on in the world. I'm really enjoying mentoring entrepreneurs. It's been a great kind of chapter for me in my life.
When you're looking at your track record, how expensive it can be not to hire you? When you look at some of the cases and maybe some of the improvements you've been able to make, let's say they could have sold for 10 million, they didn't do X, Y, and Z, or they just didn't know they sold for 6.5, like some examples like this.
Yeah, I mean, honestly, it sounds maybe self-serving, but I do think the ROI on working with me, and I suppose there are other people like me. I don't, I'm not the only person that advises or coaches, entrepreneurs. I recognize that. But for my case, particularly around exits and scale and personal freedom, the things that I really focus on, people should be getting a 10 to 100x return on their investment of working with me, because all it really takes is one idea, one thing that they do differently in the way they build their company, or the way they protect some intellectual property, or the way they find the right buyer. And it should literally add hundreds of thousands, if not millions, to their outcome. And so it's again, it's, I guess, selfishly oriented, even though I'm not really doing it for the money. It is the biggest no-brainer ever, in my opinion. Like, it always is interesting to me. I love the way you ask the question, because no one's ever asked it that way before. I'm always thinking, I don't understand how someone can't hire me, because there's almost no scenario where they're not going to get a return. And sometimes they decide not to sell their business because they've realized they love their business. They just felt trapped. They couldn't get out of the day-to-day. They couldn't get out of the grind. They're working too many hours. And I very quickly will tell them, that's not a sellable business. Nobody wants to buy a business where the founder is in the middle of everything. So let's get you out of that. Let's make sure it's scalable, efficient, and your personal freedom is going up. And then when they do that, they discover, oh, actually, I don't want to sell my business. I love it. I just felt trapped. And so to me, working with me or someone like me is such an important strategy. A lot of people tell me I don't charge enough. I had a company that tried to sell their business. It failed. They came to me out of frustration. They were hoping to sell for $25 million. We kind of restructured a lot of things. They ended up selling for $42 million in cash. And they called me after their exit and said, it's funny, Mac, I think they paid me $12,000 to work with me. They paid their bankers like $1.5 million, and they said, you added as much value as they did. And so I don't think that's the case every time, but I often hear that is 30 days of working with you, Mac, and it paid for itself. And so I think what I'm doing is important. I think myself included, I look back on my early exits and realize how much money I left on the table by not knowing what to do. And those are the things I'm telling people now. Here's what you need to do. Before you sell, please do this.
I'm happy that you said like it is, and that's one of the reasons why I like to talk or talk more with people from US than from people from Europe, because Europeans, they are like afraid to say things out like it is, but US people are more straightforward. That's why I enjoy more talking to them. And I've heard this from Europeans who have done business with Americans. Like, these guys are straightforward, and this is the beauty of it.
Yeah.
Now, when you take the last maybe 5 or 10 cases, what have been top 3, top 4 things, like very common things you have to improve or change? One, I guess, is the typical key man risk. when the founder or the operator or CEO is like too involved in all those day-to-day business relationships, everything. Like, what else can you bring out? Something like you start working with a client and it's screaming like this is something you need to change right away.
Yeah, you mentioned, one of the big ones that's very, very common is the founder or key entrepreneur being too, in the critical path, as I describe it, of the business. That has to change. That, the business has to run on systems and processes and technology and other people, not the founder. Or it's not a very sellable business because, people are basically buying you, not your company. So that is a big one. One of the other things is most every entrepreneur that when I start working with them, they really are still, even maybe they've heard me talk or maybe they've, listened to me on a podcast, they're still very stuck in their financials. And I'm really quick to say, it's not that people's financials don't matter. Of course, growing your revenue matters. And of course, if you're profitable and you have a great margin, those are all really good things. But the reality is, if someone's trying to really scale their company or really raise a lot of money, or certainly if they want to sell their business, it's got to be based on the strategic value that they're creating. And I often help entrepreneurs uncover what that is and how to focus on it, because it's there. They just aren't leaning into it. It's probably the reason their revenue is growing is something they've already done, but they're not thinking about it that way. So I often shift the way people think. Another, of course, big thing is when they think about selling their company, they're thinking about the obvious buyers, private equity firm or a larger, business in their own industry. And the more I help them get creative and think broadly about people outside their industry that might value what they've created, it really opens up their eyes in terms of, wow, I really have something here. I just need to do it differently. So that's one. And then I guess the last thing, I would say is it's also the structure. And this is the lesson I learned in my first company. So I sold my first business. I had two partners. We literally were the three shareholders. We sold it. We split the money. We got equity. So we got some cash, some ownership in the buyer. The buyer was going to go public on the NASDAQ in the US. And I'll never forget it as long as I live. The day they sent out what they call the S1, which are the documents for the initial public offering that was coming up, I was so excited to see my name in the S1 as a major shareholder of this company that was about to go public. So I'm looking through the document, and most of it's boring legal stuff, looking for my name, and I see all the other entrepreneurs of companies they bought. And I see my name, and my full name is William Mac Lackey. Yes, it's William Mac Lackey, and I, own this amount. But the person above me, and I'm making up his name, was like Tom Smith, but it didn't say Tom Smith. It said Tom Smith Family Foundation, Tom Smith Trust 1, Tom Smith Trust 2. And I'm like, what is this? And of course, in hindsight, I realized these are people that planned before their exit to have a estate management plan, wealth management. They had met with their tax advisors. They had met with their stockbrokers and figured out a way to receive shares so they didn't have to pay maximum taxes. But to me, I just literally sold my shares and got all the money and had to pay a ton of taxes, millions of dollars that I could have had just by knowing that I should have had a trust in place for my kids, or I should have had a family foundation so the money went into the foundation, not straight to me personally. So I learned the value of doing this work and this planning early. And I would say years early, in the US, if you were to do something like I just mentioned, put a trust in place or a family foundation, if you do it 2 years and 1 day before you exit, it is the safest, smartest thing in the world. If you do it 6 months before you exit, the Internal Revenue Service is going to claw that back and say, you did that to avoid taxes, and we're going to not let you do that. And so the value of 2 years is really, really important. So I often tell entrepreneurs, like, you should be working with me 2 to 3 years before you want the option to exit. And that's just one of the examples of why that's true. So yeah, I learned a lot of things like that I help entrepreneurs do differently.
So your first name is William, yeah?
William, yeah.
William. Okay, William. So I want to say a few things. First of all, I'm so happy that you decided to come to the podcast. I want this to make, like, as I learned so much from you in your whole story and journey, but especially when it comes to this strategic value creation, what we discussed early in the podcast. So I want to bring some value to you, so you can maybe one day say that I went to this guy's Mix podcast, Holdco Builders, and hoping to bring some leads to you. So where can people find you? Because there are a lot of people listening, running businesses. They maybe don't want to sell a business, but they maybe would like to sell a business if it would be more attractive to the right buyer. So where can people find you? I'm saying it out loud. You haven't paid me anything. I'm just trying to bring lots of value to you. And you mentioned in the beginning, like, there are cases where you have brought 10 to 100x return. I'm trying to do the same here. So where can people find you?
So, no, I appreciate that. Yeah, I have a primary website. So my name, as I go by, is Mac, M-A-C, and it's Mac Lackey, Lackey.com. So maclackey.com. And the other thing I did, Mick, which I think, I'd be happy to do for your listeners. So I actually created a simple URL, maclackey.com/Mick, M-I-K-K. So I can give your listeners some free stuff that I often share, some examples of exit materials, a webinar I've done, just literally free for your listeners, because I'm a big believer in, every entrepreneur, even if they think they aren't going to sell their business, what you want is you want the option. You want the option to exit. You want someone to want to buy your business. They should want to pay you a lot of money for it, because then you get to decide, do I sell or not? And if you've designed your business so people want to buy it, it just means you've built a better business. You can decide to keep it for yourself or pass it to your kids or, whatever you want to do. So I'm a big believer in creating the option to exit. And a lot of what I talk about and we've talked about today is really about that. So I tell people all the time, I don't care if you want to sell or not. I still want to help you create the option, because I know it's going to be a better business. And as an entrepreneur, you're going to have more personal freedom, which is one of the most important things in the world to me, important to me personally, and important for everybody I coach is, like, I want you to have personal freedom. Whether you choose to spend that on building another company or doing philanthropic things or your health or your family, I don't care what people do. I just want them to be out of the grind of their business, having the option to exit, and have great personal freedom. If I can do that, I'm a happy human.
Okay, awesome. I want to do this one more episode with you in the future, because I have here like 7 pages of different questions, which we couldn't cover this time because I had so many follow-up questions when it comes to your journey. Happy to do it again in the future. I'll send you an invitation again. 2 quick wrap-up questions. What I always ask is, what is the best investment advice you've ever received, and what is your favorite book?
Great questions. Best investment advice. For me, the formula for success in my own companies, and then when I look at any kind of other investments, it is always about people. So, as much as I love great ideas, great markets, I am always sort of betting on people, whether that's myself and my team or another entrepreneur. I will place a bet on people. So if I'm thinking about any kind of investment, that is 90% of my focus is who are the humans involved? What are their morals and ethics? What are their skill sets? How committed are they? How persistent are they? Because those are the things that are ultimately going to matter. In terms of favorite book, it's, you probably can, well, I don't know if you can see or not. I mean, I have so many bookcases. I'm a prolific reader. I would say, interestingly, the most recommended and gifted book that I have, at least in the last short period of time, is Die with Zero. So Bill Perkins, that book, I think, is an important one for entrepreneurs to read early in the career. I've reread that book 4 or 5 times, and that's pretty rare for me because I try to read a lot. So yeah, Die with Zero I have a bunch, but that's probably the one that I find myself referencing because it really changed the way I thought about wealth. And I recommend entrepreneurs thinking about, certainly before they really lean into building a big company or selling a company, it really changes the way you think about some of those things.
Again, this hour went super fast. Another reason for doing this podcast is meeting people like yourself. So it's super, super awesome. Again, happy to do it again in the future, more into maybe a masterclass type session where maybe I will bring someone who owns a business and you can maybe coach them live if you're happy to do that. I would be. So, but I'll send you more details. But thanks again for sharing your story today, Mac.
Thank you for having me. This has been great.